Welcome to Kitchen Table Finance.
Hello, everyone, and welcome to another exciting episode of Kitchen Table Finance. Dave is away, hopefully catching some fish over in, where is he at again, Cole?
Bozeman, Montana.
Bozeman. Hopefully catching some fish in a river somewhere in Bozeman today, I think is his plan. So as his replacement today, we got Cole Williams joining the show again. Welcome, Cole.
Good to be here.
Thank you for showing up on this beautiful Friday morning to talk about taxes. I'm sure it was top thing on your list today, right?
Yeah, it's. I'm sure all of our listeners are like, wait, I just did my taxes. Why are we talking about it? But here we are.
It's one of those things where a lot of clients, a lot of people in general, and I myself am kind of guilty of this from time to time. You do your taxes, you fill them out, you file them, you pay your, hopefully you get a refund, I guess, depending on where you're at. But then you kind of just forget about them until next year, right? And unfortunately, tax planning is served best during the year you're actually in. And so what we do for a lot of our clients right now, or the majority of them, is we get their tax returns from 2024 and we run some projections for them for where they're going to be in 2025. And we look at some of the issues we're going to talk about today and deciding, like, are there things that we should be doing differently? Are there strategies that we can potentially take advantage of? And how do we kind of think through all the things that go into retirement and taxes and make good financial decisions based on what our clients' long-term goals are, but also, how to kind of minimize that tax bill, if you will, right? The main goal of tax planning for us, and really for anyone, is your goal should be to pay taxes at the lowest rate possible, right? So that's where it gets kind of tricky, because in order to pay taxes at the lowest rate possible, you need to figure out what your current rate is, right? And that's why we run projections to figure out what tax bracket you're going to be in, what rate are you going to pay taxes on in 2025. And then also, what are your future tax rates going to look like? And that's a little bit trickier, because not only do we have to factor in what your future income will look like, but we also have to factor in what the potential tax changes are and how that might impact some of the things that you have going on right now. And how do we kind of play that game around, do we want to venture a guess as to what future tax rates will look like? Or do we want to just base everything on what the current tax rates are? And I would say it's kind of an individual decision where you could go either way, right? Like if you are concerned that tax rates are going to go up in the future because we have a pretty massive debt rolling around in the federal government, then you might be a little bit more aggressive in your tax planning. Where if you kind of plan for the status quo of kind of what we've got going on right now is what we assume will happen over the next 10, 15, 20 years, then you might want to be a little bit more conservative in those estimates. So it's all kind of a interesting game, fun game, if you will, to kind of think through what am I paying now? What am I going to pay in the future, right? So, Cole, I think the first and most important thing when it comes to thinking through taxes in retirement is, how do you actually pay your taxes in retirement, right? Like in the real world, when you have a job, usually your employer is kind enough and required to withhold taxes for you, right? So you get a paycheck and you fill out a form that tells your payroll company how much of your money they should send to the federal and state government for you if you live in a state that has state taxes, and even the local municipality. And then they automatically deduct those from your paycheck. And then what you have at tax time is just kind of squaring up with the government and saying, yeah, I paid you a little bit too much, or I didn't pay you enough, and now I owe you money. That's like the normal working year, how kind of taxes work. But it's a little bit different in retirement. Because you don't get a paycheck, right?
You do not.
And so there's really 3 different ways that you can pay taxes, Cole. Do you know what they are?
Well, one is definitely withholding. You can still withhold on your own, that's for sure.
Very good. So if you're taking a distribution from a qualified retirement account like an IRA, 401k, 403b, even a Roth IRA, which we'll talk about a little bit here, but you can actually tell your custodian, that you would like a portion of that distribution to go to federal and state taxes, right? And so let's say you take $1,000 out of your IRA every month. You could tell them, all right, I want you to send $200 to the federal government and $50 to the state of Michigan. And from there, then you would essentially get $750, and $250 would be sent to the federal government in the state of Michigan to kind of prepay your taxes, if you will, right? The other thing that you can do is pay a quarterly estimate. And so you can kind of estimate where your taxes are going to be for the year and just send a check to the federal government or the state government, or go online and do it digitally. The IRS does accept digital payments nowadays. And so you can actually every quarter send a certain amount to them that hopefully adds up to about what you end up owing at the end of the year, right? The third way is a little bit less common, and that is if you have a pension, you can have taxes withheld from your pension payment. And if you are collecting Social Security, you can actually withhold taxes from your Social Security payment. There's a form for that. You submit it, and then they start doing that same thing, basically taking a portion of that and and sending it to the federal government for tax payments. And so the first real thing to consider as you retire is, what is my tax bill going to look like, and how am I going to pay that? Am I going to withhold? Am I going to pay quarterly? And kind of the goal of that, if you will, from a tax planning perspective, is you want to, on your federal taxes, generally owe less than $1,000, because if you owe more than $1,000, you may be subject to under withholding penalty. And so then not only are you paying taxes and writing a check for more than $1,000, but you're also potentially writing a check for penalties and interest for not withholding enough, right? So that's kind of the first step, is figuring out what your income is going to be and how much taxes you're going to owe and how are you going to pay those taxes, right?
Yeah. And there's a big behavioral finance element of that too, where, some people prefer to do big quarterly or annual payments for things, and some people prefer the monthly. I think the research usually indicates that people tend to prefer the smaller monthlies. It's generally speaking easier to budget for, and it feels different handing over a bunch of small payments than handing over one or four large payments split up across the course of the year. Yeah. But everybody's different.
Absolutely. And the other thing that I would add to that too is a lot of people coming into retirement are kind of used to getting a large refund at the end of the year. And so there's this great debate among financial planners and tax professionals of, if you're getting a refund, what you're really doing is giving a 0% interest loan to the federal government to hold on to your money for you and give it back to you when you go to fill out your taxes every April, right? And so there is definitely some downside to getting a big refund. But the flip side of that is a lot of people enjoy that because it's kind of this like forced savings metrics, if you will, where if you're getting, a $5,000, $6,000, $7,000 refund every year, all of a sudden, if you had that extra money in your paycheck, you might not roll around to April with $5,000. But if you give it to the government to hold on to for you, you're much more potentially likely to have $5,000 at the end of that time frame, right?
And the refund feels like free money. It feels like you won a tiny little mini jackpot sometimes.
Well, not only does it feel like free money, I feel like a lot of people feel like, I'm not paying very much taxes. Look how much money I got back, right? Which has nothing to do with it, right? You can pay $100,000 in taxes and get a refund because you paid $105,000 as opposed to $100. You're still paying a lot of taxes.
Look at this $5,000 I got.
You needed to. Yeah, exactly. So some considerations. I know we've had clients who have, been used to that refund. And one workaround is we basically tried to get their tax withholding about to what they owed and then just took an extra distribution every April from their account, as opposed to, just giving it to the government all year long to hold on for you and give it back to you. So definitely some workarounds for our retirees there. The next kind of question that goes into this, and especially as we are thinking about how do we pay taxes in retirement, how much are we going to owe, is where should you take money from in retirement, right? And so not a lot of our clients these days are coming in with pensions. And so, if you don't have a pension, and a lot of them are retiring before their or before Social Security, or even deciding to not take Social Security right away and delay that decision. And so what you need to do then is you have to generate income, right? And so there better be at least one of these accounts that you can take money out of, right? Otherwise, you will have to start Social Security or pension. So there's really three different mixes that we commonly see, right? And that is a taxable brokerage account, which is essentially money that's available to you, but you pay taxes on any gains that you have every year, right? And then we also have pre-tax retirement accounts. So think of IRAs, 401ks, things like that, where you put money in pre-tax, and then when you take it out, you have to pay taxes on it. And then there is also the Roth, which is you put money in after tax, and whatever it grows to, provided that you have had it for 5 years or until age 59 and a half, it comes out tax-free, right? And so the question then becomes is, if you have all three of those, which one of those accounts do you take money out of first, right? And kind of the rule of thumb for a lot of people is generally to take money out of your taxable account first, then take it out of your pre-tax account, and then take it out of your Roth accounts, right? And usually in that order. But this is where tax planning can come in, because if you take everything out of your taxable account and you have zero taxable income, you're really kind of giving away the gift of any standard deduction that you might have, right? Which is $15,000 for an individual and $30,000 for a couple. So you basically, the first $30,000 for a married couple is essentially taxed at 0%. And so if I can take money out of my pre-tax account and pay 0% taxes on it up to $30,000, I probably want to take advantage of that, as opposed to taking it out and paying taxes on it. So there's some maneuvering that goes around with what do we take out of what account and why and when, right? And so it's not as easy as just going in that order all the time. And it depends on some of the other things that you have going on, like your Social Security or pensions or other things, right? And so that's kind of that next big decision of, where do I take money out of and how much tax am I going to pay? And then the third thing that you have to consider when talking about tax planning and retirement is an RMD. What can you explain to our listeners what an RMD is, Cole?
An RMD is a required minimum distribution that must be taken from pre-tax accounts, like an IRA. It depends on your age group. For some people, it is 70 and a half. For some people, it is, I forget, is it 72? Is that the upper threshold? Now, is it 73?
72.
And so the government effectively says, hey, we've been allowing you to defer these taxes for many, many, many years, and we want to get paid. So they start making you take money from those accounts to generate taxable income, and they start taxing you.
You got it. Several different rules, and we're not going to go into all of the rules today. This is kind of our general overview about things people should be thinking about from a tax planning standpoint, and then we're going to do a deeper dive on some of these topics as well. But as far as a required minimum distribution, one of my least favorite rules from the IRS was the RMDs started at the age of 70 and a half. Because why? Because we're the IRS and 70 and a half seems reasonable to us, right? How many people know their half birthday? Very few of them. And it does make things confusing. And to make things even more confusing, not only is the beginning age 70 and a half for people who were born before June 30th of 1949, you also don't have to technically take out that required minimum distribution that first year until April of the following year. And so not only is it a half year, but also you don't technically have to take it out until the next year, which makes things even more complicated. Most people don't, but it is a possibility to delay that first year. And there are some potential good reasons in tax planning to do that. But just know that if you delay it past your first year, then you have to take 2 distributions in that your first year, or technically your second year of required minimum distributions. For those of us born between July 1st, 1949 and December 31st of 1950, your required minimum distribution starting date is age 72. And then for those between January 1st, 1951 and December 31st, 1959, the RMD start age is 73. And then for all of us youngsters born before or after January 1st of 1960, the RMD starting age is 75. When it comes to required minimum distributions, and we see a lot of this floating around social media nowadays about how bad of a deal a 401k or a pre-tax account is, because at some point you have to take these required minimum distributions. And if you are diligent in saving, you might have millions of dollars, or $1 million or more dollars in a pre-tax retirement account. And when you have to start taking those distributions, they come out in pretty large chunks, and they typically only grow from there in size, right? And so it's this kind of, as Ed Slott likes to call it, I don't love this term, but it's the retirement ticking time bomb, right? Of like, at some point, you're going to have to take a bunch of money out of this account. You're going to have to pay taxes on it all in 1 year. And there's no recourse. There's no way to get around it. It has to potentially happen. That's not true. There is a couple of things that you can potentially do from a planning aspect to minimize the taxes of some of that. But so the consideration then is, how will that distribution affect your taxes in the future? And this goes back to that tax planning philosophy of, we want to pay taxes at the lowest tax rate possible, right? And so when we look at retirees and we look at like projecting out like where you're going to be, what your required minimum distribution is going to be at your required beginning date, but also, in your 80s and 90s, because that number goes up every year. How big are those going to be, and what tax bracket is that potentially going to push you in? And for a lot of folks, we have this kind of nice window where they're not collecting Social Security and they don't have a pension. And so we get to kind of make up the rules, because they have a couple of different accounts to pull money out of as far as how much income they're going to show in a specific year. And so you might have this gap between stopping work and starting required minimum distributions, where you actually have a pretty low tax rate and in a pretty favorable tax situation. And that's where you might consider taking money out of your pre-tax accounts in order to utilize those lower tax brackets, knowing that you're going to have higher ones in the future. And I know, Cole, you do a lot of work. We actually have software, Income Lab, that we use to kind of project and plan this stuff out. And I know that your famous YouTube video is either up or going to be up soon, just kind of explaining some of that, right?
Yep, it is. And I think that it's easy sometimes to think about, tax planning. There's some nasty words that are thrown around, like tax loopholes and things like that. Mm-hmm. And I think it's also important to note that things like Roth conversions and different strategies implemented in tax planning are all put in place by the IRS to benefit people. I mean, it isn't unethical. It isn't illegal. It's nothing like that. It's all stuff that is put in place to just help you lessen your tax burden. Things like, obviously, we talked about the standard deduction, itemized deduction, Roth conversions. It's just whether or not you choose to take advantage of those things to benefit you and your family. Because sometimes I feel like I hear people talk about, well, I want to make sure I'm paying my fair share, which, trust me, you're gonna. It's just a matter of how big is your fair share truly going to be at the end of the day.
You are young and optimistic, and I love that about you, Cole. But as your counterpart that's not here today would say, it's actually a good deal for the IRS and the government, because they would prefer to get your tax money now because of how they budget and how they're able to do things. So they're kind of sacrificing future revenue down the road so that they can have revenue now, is the more pessimistic view of why these things exist.
Some might call it the time value of money.
Trying to benefit the end consumer, right? Why large RMDs potentially cause a problem is they can increase your tax bracket. You can also see an increase in your Medicare insurance costs, something called IRMA, which is essentially the more money that you make in a given year, the potential for you to pay more in Medicare insurance costs, right? And so that's something that you have to be mindful of. It can also cause you to be subject to the net investment income tax, right? So if you get pushed up into a higher tax bracket and have more potential taxable income, that also can affect some of the taxation of your other investments in the form of net investment income tax, which is a 3.8% tax in addition to, capital gains or general interest. And so that's another consideration of one of those problems. And the other thing too is your Social Security taxation. A lot of people don't realize Social Security is actually taxable. It's kind of a weird sliding scale where the more income that you have, the higher percentage of your Social Security is taxable, all the way up to 85% of your benefit can be taxable at the top end. When you don't have a lot of income, you might only be paying taxes on 50% of your Social Security. All of a sudden you get an RMD, and the next thing you know, you're paying it on 85% of your Social Security. So a lot of that can have potential impact on your taxation. And so those are also things that we need to consider if we're considering a Roth conversion, right? So if we do believe that we're going to be in a lower tax bracket now than we are in the future, it does make sense to start looking at the potential of a Roth conversion. But then we have to pay attention to things like what tax bracket you're in, where your Medicare insurance costs are, how does that impact your net investment income tax, how does that impact any potential credits you might qualify for. Anytime we agree to increase your income, there's potential pitfalls that you got to be careful of, right? And so it's not just as easy as, hey, I'm in the 12% tax bracket now, I'm going to be in the 24% tax bracket in retirement, so I'll just convert as much as I want and pay the taxes now, right? Unfortunately, there's a lot more that goes into that you have to be careful of. One other big tax thing that we talk about quite a bit around here is how charitable contributions affect your taxes in retirement, right? And so that's one of those things where you get to retirement and maybe you are blessed to have enough money for yourself and some left over, and you decide that you want to be charitable with those funds, which we see a lot of in our firm. And so thinking through like how that potentially impacts your taxes, a lot of charitable contributions fall into the itemized deduction bucket, right? And so again, the itemized deduction for 2025 is $15,000 for single filers, $30,000 for married couples. And so you have to be doing some pretty heavy charitable contributions in order to be over and above your itemized deductions in a lot of cases. Don't quote me on this. I know it's somewhere in the ballpark, but I think it was something like, the last time I checked, it was like 80% of people now take the standard deduction, where before it was like below 50 because they increased so much. And so a lot of those charitable distributions from a tax perspective don't necessarily benefit you as much anymore. But fear not, especially as it comes to RMDs. Once you reach the age of 70 and a half, you can do something called a qualified charitable distribution, where you can actually take money out of your IRA, send it directly to a charity, and that does not count as taxable income for you, even though it's a distribution from your IRA. So it's a way to kind of lower your future RMDs, or even count for some of your RMDs, but also get that tax deduction from taking money out of your IRA. So there's a lot of considerations and planning that go into that. But we do quite a few qualified charitable distributions every year. Just kind of rounding out some other considerations without going into too much detail, Cole. 529 plan distributions come up occasionally in retirement planning, which sounds strange, but who am I to judge? People are having kids later and later. And so you may have some extra 529 plan money that your kids either didn't use. And so what do you do with that, right? And there's some considerations there. Another one that we're seeing more of is HSA withdrawal options and taxes. So we've got a lot of clients who are contributing to their HSA, choosing not to use it for medical expenses, and investing it, letting it compound and grow so that they can use it in retirement. And so that kind of is another one of those buckets, along with the pre-tax or the taxable account, the pre-tax IRA, the Roth IRA, and then the HSA, which is tax-free as long as you use it for qualified medical expenses, which most of our retirees have their fair share of, right? And there's some things in retirement that you can use those. And so just being mindful of what those are and how you're going to use that in retirement. Also, paying attention to your capital gains tax rate. So capital gains tax, you want to explain what a capital gains tax is, Cole?
I would love to. So there's effectively two primary tax systems, tax brackets. So the first one is ordinary earned income is the best way to think about that. You have a job, you get a paycheck, earned income, which starts at 10% and goes all the way up to 37% currently for the highest bracket. Capital gains rates is the lowest bracket is 0, the mid bracket is 15, and the highest is 20%. Effectively, capital gains is you buy a rental house and the rental house costs $100,000, and you sell the rental house 10 years later for $200,000. You have $100,000 gain, and depending upon where you fall in those brackets, that determines how much of that gain is taxed at which capital gains rate.
Yep. So just something that if you have those types of investments, you want to be mindful of, because again, it's one of those situations where, especially in a long retirement, you might have years where you're in a 0% capital gains tax, and you might have years when you're in a 20%. And so knowing those differences and planning those things is important. We also have something called net unrealized appreciation. Have you run across that in your CFP book yet, Cole?
Yeah, it's complicated. Yeah.
Well, the good news is we don't see it very often anymore because it really has to do with employer stock inside of your 401k retirement plan and how that is potentially taxed. And a lot of employers don't, we don't see it as much anymore. I think Enron kind of rightfully scared everybody away from having a bunch of company stock in your 401k plan, but it does come across occasionally. And just the theory behind that is if you meet the rules and regulations, you can actually take a distribution of your stock and pay ordinary income on the basis so that then you can turn around and sell the gains for long-term capital gains at long-term capital gains rate, which is normally lower than what your ordinary income rate is. So it's a way to kind of potentially save on some taxes. I'll actually throw in, we've got a flow chart that we use here. If people are interested in that, we can throw it in the show notes. That's pretty helpful. The last couple things, tax law changes. So we do all this great planning based on the information we have and we know. And then, there's a big, beautiful tax bill coming and everything changes potentially.
Allegedly.
And so then we have to figure out what's next, right? And there's things that we want to do now before the tax bill happens. Do we want to wait until after? There will be tax changes in somebody's retirement, no doubt about it. And then the last thing is large medical expenses, and can you claim medical expenses? And the basic idea there is it is an itemized deduction again, and you can only start claiming if it's 7.5% of your AGI and greater. So you only can start claiming after it's a pretty hefty medical bill, and it depends on how much income that you have. So some other considerations to go into that. So with that, Cole, that's just our general overview of all the things we think about when it comes to retirement and tax planning. And the next
so you don't have to.
Yeah, that's right. The next couple of weeks, we're going to dive into some more specifics of what those thought processes are and how we potentially look at those things. So, tax planning, Cole, gotta love it.
Gosh, yeah, that's one of my favorite scenes in The Day After Tomorrow, the Dennis Quaid movie, is when they're stuck in the New York City library in the Ice Age, and one of the characters is like, "Listen, man, we have a whole section of tax law that we can burn to stay warm." And I'm like, "Yeah, you're right."
Tax season's never done around here, so that's what we do. Cole, as always, thanks for stepping in. It has been a pleasure, my friend.
Thank you very much. It's been great.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.